Hello and welcome back to part 3 of our real estate investment growth course. The series that is turning beginners into confident, global level investors. If you watched part 1 and part 2, you already understand the foundation of investments and global property trends. But now it's time to go deeper, much deeper. Because every successful investor from New York to Dubai, from Texas to Toronto, from Karachi to Kuala Lumpur, all of them master one thing: market cycles and risk management. This is where fortunes are either made or destroyed. This is the knowledge that keeps you safe during recession, inflation, war, or global uncertainty. This is the part most investors skip, and that's why most investors fail. So today I'm giving you part 3, your most powerful step toward becoming a recession-proof, globally aware property investor. Let's get started. Every real estate market in the world, whether it's California, Florida, Texas, New York, Dubai, London, or Pakistan, moves in cycles. These cycles are not random. They follow a predictable pattern. Understanding the pattern gives you the ability to buy when the prices are low, avoid overpriced markets, and sell when the demand is high. The 4 major real estate cycles include recovery phase. Prices are down, buyers are few, smart investors enter here. Expansion phase. Prices rise, supply increases, new construction starts. Hyper supply phase. Too many properties, demand slows, market overheats. And recession phase. Prices drop, rental yields fall, panic selling begins. In places like the USA, these cycles can last 7 to 12 years. In emerging countries, cycles are faster because markets react quickly to economic or political events. Mastering these cycles means you never guess. You strategically time your investments, just like top global investors do. Most beginners obsess over which property is best: house, apartment, land, or commercial. But seasoned investors will tell you something different. The timing of the cycle is more important than the property itself. For example, buying a great apartment during hypersupply means you'll struggle with low rents. Buying average land during recovery can double your investment. Buying commercial property during recession is risky. Tenants disappear. And buying residential property during expansion generates reliable cash flow. Real estate is like surfing. Even the best surfboard won't help if you catch the wrong wave. But the right wave, even with a simple board, pushes you forward effortlessly. In markets such as Miami, Austin, Dubai, and Istanbul, investors who understood cycles bought during downturns and created wealth while others panicked. The market doesn't care about emotions. It rewards those who read the wave, not those who jump blindly. You must learn to read the signals a market gives before it heats up. These signals often appear 6 to 18 months before price jumps. Here are the most reliable indicators. Population growth. When more people move into a city like Dallas, Houston, or Atlanta, rent demand increases. Employment growth. Tech hubs. Manufacturing zones and port cities show strong appreciation because jobs attract tenants. Infrastructure projects, highways, airports, economic corridors, new metro lines, these always boost future prices. Interest rate drop. Lower interest rate increase mortgage approvals, boosting demand. Foreign investment. Cities like Dubai, Doha, and Toronto boomed because international investors started buying aggressively, and low housing inventory. If fewer houses are available than the number of buyers, prices skyrocket. Smart investors watch these signs like a doctor reads symptoms. You don't guess, you diagnose, and then take action before the crowd. Just like there are signals for growth, there are also clear warnings of a crash. Ignoring these warnings is how people lose millions. Here are the red flags. Too much construction. Oversupply always leads to falling prices. Rising interest rates. High borrowing cost reduce buying power, causing seller to panic. Falling rental demand. If vacancy rates rise, it means people are leaving the city or cannot afford rent. Economic or political instability. Wars, elections, sanctions, and recessions can freeze transactions. And rapid price jumps. If prices rise too fast, it's usually a bubble, not real growth. Cities like Las Vegas, 2008, Dubai, 2014, and many developing markets suffered because investors ignored these signals. Real estate never crashes without warning. The signs are always there. You just need trained eyes to see them. Risk management is not only about avoiding loss, it's about controlling loss so it never destroys your investment journey. Top global investors follow 3 principles. Never invest emotional money. If you need quick profit, you will panic sell. Never put all money in one property. True diversification means spreading across locations and types. And always keep 6 to 12 months emergency cash. This protects you during rent gaps, repairs, or market downturns. Risk management is not fear, it's strategy. It's what kept investors stable during the 2008 crisis, COVID-19 lockdowns, rising inflation, and sudden interest rate hikes. Real estate rewards patience and discipline, not gambling. Diversification protects investors globally, especially in volatile markets. You can diversify by location, have properties in different cities or states. For example, a US investor might diversify between Florida or Arizona and North Carolina. Property type: residential, rental, land, commercial. Market cycle stage: buy some during recovery, some during expansion. And currency exposure: keeping part of your investment in strong dollar economies like the USA protects you from the local currency crashes. Diversification is the seat belt of your investment car. It doesn't stop the accident, but it prevents your loss from becoming fatal. Pandemics, wars, inflation, banking failures. These events change everything, but not always in the way people expect. During global crises, Luxury properties often drop. Affordable housing becomes more valuable. Land becomes a safe asset. Rental properties outperform. Mortgages decline due to high interest. Gold and real estate become safe havens. When the world panics, smart investors position themselves. COVID-19 proved this. Rental markets crashed in big cities but boomed in suburban and remote work locations. Real estate does not die during crises, it transforms. Perfect timing is not luck, it's awareness. You must watch interest rate announcements, new development approvals, bank lending policies, local job reports, population shifts, and housing inventory numbers. When inventory is high and prices are soft, that's your moment. When inventory is low and demand is exploding, that's a good time to sell or hold. Real estate rewards those who act early, not those who wait for perfect conditions. Every investment needs an exit plan. This is where most investors fail. There are three main exit strategies. Sell at market peak. When prices hit historical highs, it's time to harvest profit. Hold for long-term rent. Stable rental markets like Texas or North Carolina give 20 to 30 years of cash flow. Refinance instead of selling. You keep the property but withdraw cash using bank financing without losing ownership. Exit strategy is not about selling, it's about maximizing growth while protecting your capital. The US real estate market is one of the most stable and predictable on earth. Cycles are slower, data is public, and regulations protect investors. This is why global investors trust US markets for long-term stability. In contrast, Middle East cycles are faster due to foreign-driven demand. South Asian markets are influenced by politics and currency fluctuations. And European markets depend heavily on immigration and economic growth. Understanding these differences allows you to build a global portfolio safely and strategically. And that brings us to the end of part 3 of your real estate investment growth course. If you completed all 3 parts so far, congratulations! You're already ahead of 99% of people who enter real estate without education, without direction, and without strategy. But you are different. You're building knowledge, you're building confidence, and you're building a future where your investments work for you, even during inflation, recession, or global uncertainty. If you want part 4, comment part 4 please, right now. Don't forget to like, subscribe and share this course with someone who wants financial freedom. See you in part 4. Your real estate journey has only just begun.